Walking through the bustling financial districts of major global capitals reveals a palpable shift in investor sentiment regarding wealth preservation. The traditional reliance on fiat currencies is demonstrably fracturing under intense macroeconomic pressure. Capital allocators are aggressively pivoting toward tangible commodities to shield their portfolios from persistent inflation and geopolitical instability. For decades, the United States currency reigned supreme as the ultimate harbor for global wealth during times of crisis. However, shifting geopolitical alliances and staggering sovereign debt levels have severely eroded this historical dominance. Investors now view the reserve currency with mounting skepticism as inflationary policies diminish its purchasing power. The fundamental contrast between fiat money and precious metals lies in their respective supply mechanisms and intrinsic properties. Central banks possess the unlimited capacity to print paper money, which systematically dilutes its overall market value. Conversely, the yellow metal requires immense physical labor and capital expenditure to extract from Earth. This inherent scarcity ensures that physical metals cannot be artificially multiplied by mere administrative decrees or monetary policy shifts. Consequently, cautious investors increasingly prefer assets with fixed global supplies to protect their accumulated wealth. The transition away from dollar dominance accelerates as sovereign nations strategically diversify their central bank reserves. Weaponizing the global financial system through aggressive economic sanctions has unintentionally accelerated this massive currency diversification trend worldwide. Emerging economies observe these punitive measures and actively seek alternative stores of value outside Western financial control. Physical commodities offer absolute sovereignty because they carry no inherent counterparty risks or settlement obligations. When inflation remains stubbornly high, the real yield on standard government bonds frequently drops into negative territory. This mathematical reality destroys the primary incentive for holding massive sums of traditional fiat currency. Capital naturally flows toward hard assets that historically maintain their relative value against the rising costs of goods. The historical definition of a safe haven asset involves reliable capital preservation during periods of extreme systemic stress. The physical yellow metal perfectly embodies this definition because it exists entirely outside the modern banking architecture. It survives financial panics, corporate bankruptcies, and sovereign defaults without suffering any permanent intrinsic loss. During the massive economic contractions of the past century, physical metals consistently outperformed traditional equity and credit markets. This reliable inverse correlation provides vital structural balance to modern institutional investment portfolios worldwide. When equity valuations collapse under economic pressure, commodity prices typically surge as panic drives a massive safety flight. Geopolitical conflicts routinely expose the underlying fragility of deeply interconnected global supply chains and complex electronic trading networks. A tangible asset provides unparalleled psychological comfort because it can be physically held and independently verified. This physical reality makes it completely immune to cyber attacks, infrastructure failures, or digital manipulation attempts. The enduring psychological appeal of this specific commodity transcends cultural boundaries and spans thousands of years of human history. Citizens in developing nations routinely utilize physical jewelry and small bars as their primary savings mechanism. This grassroots demand creates a massive structural floor beneath global prices during severe macroeconomic uncertainty. Institutional asset managers are completely reevaluating their long-term strategic allocations for the upcoming calendar year. Leading financial firms now openly acknowledge that previous risk models severely underestimated the persistence of global inflation. Consequently, these massive investment funds are actively expanding their dedicated commodity exposure to hedge against monetary debasement. The global macroeconomic environment of early 2026 presents unprecedented challenges for traditional fixed-income portfolio strategies. Rising interest rates have severely damaged the defensive characteristics of long-duration government bond holdings. Investment committees must therefore identify alternative reliable stabilizers to protect client capital during upcoming extreme market volatility. Many prominent global banks have recently published comprehensive research reports detailing their revised strategic outlooks. These detailed publications strongly advocate for a permanent structural allocation to precious metals within diversified investment portfolios. The consensus suggests that the current cycle of monetary expansion will inevitably drive hard asset valuations significantly higher. Wealth management divisions catering to ultra-high net worth individuals report unprecedented client demand for physical bullion delivery. These sophisticated investors remain deeply concerned about potential systemic banking failures and widespread currency devaluation risks. They prioritize absolute capital preservation over incremental yield generation in this highly uncertain global economic environment. The transition from digital derivatives back to fully allocated physical holdings represents a profound shift in risk assessment. Custodial banks report surging requests for segregated vault storage across major financial centers like London and Zurich. This intense preference for direct ownership highlights a growing distrust of complex paper market derivatives. Analysts at the John Pierpont Morgan Financial Institution recently released their highly anticipated commodity market outlook for the current year. Their quantitative models project a sustained upward trajectory driven by robust fundamental demand and constrained global supply. The firm identifies aggressive central bank accumulation as the primary catalyst supporting this. The research team at John Pierpont Morgan expects prices to confidently breach the $2,500 threshold soon. They attribute this anticipated milestone to structurally higher baseline inflation and lingering fears of a global recession. Their analysts recommend that clients utilize any minor price corrections as strategic entries. According to John Pierpont Morgan, the traditional relationship between real interest rates and commodity valuations has fundamentally structurally shifted. In previous decades, rising yields would inevitably trigger massive liquidations across all non-yielding defensive asset classes. However, current market dynamics demonstrate remarkable price resilience despite aggressive monetary tightening central campaigns. The Goldman Sachs institution maintains an equally robust and unequivocally bullish perspective regarding the future trajectory of global markets. Their expert commodity strategists recently upgraded their 12-month price targets, citing an unprecedented alignment of macroeconomic variables. They emphasize the massive structural deficit in new mining discoveries as critical drivers. The leading analysts at Goldman Sachs identify the ongoing weaponization of global trade tariffs as a major bullish factor. They argue that escalating trade tensions will force sovereign nations to rapidly accumulate completely neutral reserve assets. This sovereign buying spree creates immense upward pressure on prices regardless of retail sentiment. Goldman Sachs explicitly advises institutional clients to maintain maximum allowable weightings in tangible commodities throughout the current calendar year. Their sophisticated risk models indicate that traditional equity hedges will likely fail during the next major liquidity crisis. Therefore, holding physical metal remains the most mathematically sound strategy to mitigate risks. The combined analytical weight of John Pierpont Morgan and Goldman Sachs strongly influences global capital flows and broad sentiment. When these two massive financial institutions simultaneously issue bullish forecasts, it typically triggers massive institutional buying programs globally. Smaller regional banks and independent wealth managers naturally follow the strategic guidance established. To fully comprehend the current market dynamics, one must carefully analyze the overwhelming influence of the Asian continent. The People's Republic of China has emerged as the most dominant force driving global physical commodity consumption today. Their massive population possesses an incredibly deep cultural affinity for acquiring tangible wealth during crises. Retail demand across major Chinese metropolitan centers has reached unprecedented historical levels during the past several economic quarters. Middle-class citizens actively purchase small bars and investment-grade coins to protect their rapidly declining property wealth. The severe downturn in domestic real estate markets leaves Chinese savers with few alternatives. The domestic stock market in China has suffered massive capital outflows due to structural economic slowdowns and regulatory crackdowns. Consequently, retail investors are frantically converting their excess savings into reliable, tangible assets to preserve their purchasing power. This massive wave of grassroots consumer demand absorbs nearly all newly minted supplies. Beyond simple retail consumption, the Central Bank of China executes a highly secretive and aggressive accumulation strategy monthly. They systematically convert their massive trade surpluses into physical bullion to deliberately reduce their heavy dollar dependency. This continuous sovereign buying provides an incredibly strong mathematical floor beneath global spot prices everywhere. The Shanghai Gold Exchange now rivals Western commodity exchanges in terms of total trading volume and global pricing influence. This monumental shift in market power reflects the broader transition of economic gravity from Western nations toward Asia. Asian buyers strongly prefer immediate physical delivery rather than settling transactions using paper. This massive drain of physical inventory from Western vaults severely constrains the available floating supply in London and New York. When global institutional investors suddenly attempt to build significant positions, they encounter a completely illiquid physical market environment. This severe supply constraint inevitably forces spot prices significantly higher for buyers. The continuous flow of wealth from the Western Hemisphere into Eastern vaults represents a permanent macroeconomic paradigm shift. Chinese policymakers actively encourage their massive domestic population to accumulate precious metals as a patriotic financial duty. This coordinated national strategy ensures that regional demand will remain exceptionally robust regardless of cycles. The intersection of massive Chinese consumer demand and aggressive sovereign accumulation creates an incredibly powerful bullish market narrative. Global mining companies simply cannot extract enough new material from the earth to satisfy this insatiable Eastern appetite. The fundamental laws of supply and demand dictate that prices must mathematically rise continually. As we navigate the complex financial landscape of 2026, the case for tangible assets becomes remarkably clear. The United States dollar faces unprecedented structural challenges that threaten its long-standing status as the ultimate reserve currency. Investors correctly recognize that massive fiscal deficits will inevitably require deeply inflationary policies. This realization drives a massive global rotation out of fiat currencies and directly into historically proven wealth preservation vehicles. The physical yellow metal stands alone as the only globally recognized asset completely free from sovereign counterparty risks. It guarantees absolute financial privacy and total operational independence from increasingly intrusive centralized surveillance. The historical performance data clearly validates the decision to maintain significant commodity allocations during periods of elevated inflation. While paper wealth can vanish instantly through corporate bankruptcies or market crashes, physical bullion endures indefinitely without degradation. This incredible permanence offers anxious investors the psychological comfort required to survive incredibly volatile markets. The strategic transition away from the greenback is not merely a temporary cyclical trend, but a permanent structural evolution. Sovereign nations are deliberately architecting new settlement networks that completely bypass traditional Western financial channels and clearinghouses. These emerging alternative financial systems heavily utilize physical commodities to perfectly balance massive trades. When major investment banks like John Pierpont Morgan and Goldman Sachs simultaneously agree on a macroeconomic thesis, markets notice. Their exceptionally bullish forecasts validate the underlying concerns held by massive institutional capital allocators across the entire globe. They mathematically prove that traditional portfolio construction models are dangerously obsolete in this era. The global elite recognize that the era of artificial monetary stability engineered by central banks has officially concluded permanently. We are entering a highly volatile decade defined by persistent supply chain disruptions and rapidly escalating regional military conflicts. In this dangerous environment, tangible assets provide the only reliable mathematical defense. Absolutely. The undeniable gravitational pull of Chinese demand fundamentally alters the traditional pricing mechanisms of global commodity trading markets completely. Western speculative traders can no longer manipulate spot prices, lower through aggressive short selling of unbacked paper derivative contracts. The relentless Eastern demand for immediate physical delivery rapidly exposes these artificial schemes. Every single ounce shipped to Asian buyers represents permanent removal from the available floating supply of global financial markets. These massive reserves are securely locked within private family vaults and massive sovereign depositories for multiple future generations. This continuous draining of Western inventory guarantees that future supply deficits will become permanent. The fundamental narrative surrounding safe haven assets has officially evolved to reflect the harsh realities of modern global finance. A true haven must offer complete protection against both sudden market crashes and the slow, steady destruction of inflation. Only fully allocated physical commodities successfully meet both of these incredibly demanding criteria. As global debt levels cross critical mathematical thresholds, the mathematical probability of a severe currency crisis increases exponentially daily. Smart money anticipates these systemic failures by positioning capital in assets that cannot be printed or debased by politicians. The global rush into hard assets represents a completely rational mathematical response universally. The massive technological advancements in modern mining simply cannot compensate for the rapidly declining quality of newly discovered ores. Extracting each new ounce requires significantly more energy, chemicals, and massive capital investment than ever before in human history. This steadily rising fundamental cost of production establishes a firm mathematical pricing floor. Environmental regulations further restrict the ability of major global mining conglomerates to rapidly expand their current physical extraction operations. Obtaining the necessary permits to open massive new facilities often requires more than a decade of complex legal negotiations. This regulatory friction guarantees that total global supply will remain structurally constrained regardless. The ultimate failure of modern monetary theory is currently playing out across global financial markets in real time daily. Citizens universally realize that expanding the monetary base does not magically create actual tangible wealth or improve living standards. It simply transfers massive purchasing power away from diligent savers directly toward governments. To combat this stealth confiscation of wealth, investors must actively seek refuge outside the completely controlled fiat currency system. The yellow metal provides the perfect escape hatch because it is universally recognized and incredibly dense in fundamental value. A small physical holding can securely store massive amounts of accumulated capital permanently. The ongoing weaponization of the dollar heavily incentivizes the development of alternative commodity-backed currencies by major emerging economies. If these new sovereign settlement mechanisms gain widespread global traction, the absolute demand for physical backing will absolutely explode. This potential macroeconomic paradigm shift presents the most massive upside catalyst historically forever. Analysts at John Pierpont Morgan closely monitor these massive international trade developments to accurately update their proprietary valuation mathematical models. They recognize that a successful transition away from dollar hegemony requires massive physical reserves to instill essential global confidence. Their incredibly bullish price targets actively reflect the mathematical necessity of higher valuations. Goldman Sachs emphasizes that the historical correlation between tangible commodities and broad equity markets is officially breaking down rapidly. Investors can no longer rely on standard diversification models to properly protect their wealth during severe macroeconomic liquidity crises. Only completely independent hard assets provide genuine massive structural protection when systems fail. The massive cultural significance of tangible wealth in Asian societies cannot be fully quantified by standard Western mathematical algorithms. It represents deep generational security and essential social status that completely transcends mere short-term speculative financial trading behavior. This profound emotional connection ensures that massive physical accumulation will aggressively persist continually. The total collapse of confidence in domestic Chinese real estate markets has accelerated this massive historical wealth transfer significantly. Millions of newly affluent citizens now view physical commodities as the only truly secure vehicle for intergenerational wealth preservation. This massive structural shift in consumer financial behavior permanently alters global supply balances. As the year 2026 progresses, the fundamental divergence between paper assets and physical reality becomes absolutely undeniable. Equity markets remain dangerously elevated by massive injections of central bank liquidity, rather than genuine underlying corporate economic growth. Savvy investors desperately seek to convert artificial paper profits into permanent tangible wealth. The physical commodity markets offer the perfect destination for this massive defensive rotation of global institutional and retail capital. The intrinsic value of the metal remains entirely independent of corporate earnings reports or political election outcomes and promises. It silently stands as the ultimate absolute mathematical truth in a leveraged system. The global wealth management industry is completely restructuring its fundamental approach to long-term strategic macroeconomic portfolio risk management. Financial advisors who previously dismissed physical commodities are now aggressively recommending maximum allowable allocations to their wealthy private clients. This massive professional capitulation strongly validates the underlying macroeconomic thesis driving markets. The specific combination of constrained global supply and rapidly expanding international demand creates a highly explosive upward price mechanism. When massive institutional capital attempts to squeeze into an incredibly tiny physical market, the resulting price action is violent. We are currently witnessing the preliminary stages of a massive historic repricing universally. The fundamental arguments presented by Goldman Sachs and John Pierpont Morgan provide absolute intellectual cover for massive institutional capital deployments. Portfolio managers can safely allocate billions of dollars without facing massive career risk because the industry titans endorse it. This herd mentality among massive global asset managers guarantees continuous buying pressure. The structural economic weakness of the United States guarantees that massive deficit spending will aggressively continue for many decades. Politicians entirely lack the fundamental courage required to implement the massive austerity measures needed to balance the national budget. Consequently, the central bank will inevitably be forced to monetize this massive debt. This massive guaranteed future dilution of the global reserve currency makes holding tangible assets an absolute mathematical financial necessity. Investors who fail to recognize this massive macroeconomic reality will inevitably suffer massive losses in their absolute purchasing power. The massive global flight to safety is completely driven by calculated risk assessment. The massive physical accumulation by the Chinese central bank serves as a massive warning signal to Western financial institutions. The East is deliberately preparing for a massive restructuring of the entire global financial architecture and international monetary system. They understand that he who holds the physical wealth completely dictates new rules. Western investors must urgently adapt to this massive new geopolitical reality or risk being completely marginalized financially very soon. Relying entirely on digital wealth completely vulnerable to sovereign confiscation or massive systemic infrastructure failure is incredibly reckless behavior. True financial sovereignty requires massive direct ownership of completely unencumbered physical assets immediately. As we look deeply into the massive uncertain future of the global financial economy, one absolute truth remains totally clear. The ultimate safe haven asset has successfully defended massive generational wealth through thousands of years of massive human turmoil. It will undoubtedly continue to absolutely perform this vital macroeconomic function forever. The massive ongoing transition from digital illusions of wealth back toward fundamental tangible reality is now completely historically unstoppable. Savvy global investors, institutions, and sovereign nations are all massively mathematically aligned in their aggressive pursuit of physical security. This massive collective global action guarantees that the ultimate asset will massively shine.